Wonderful. Good morning and welcome to the March 2026 update of the Spears & Associates Drilling and Production Outlook. I'm John Spears.
And I'm Richard Spears, and today's going to be an interesting and odd.
Yes.
We're going to break the mold from probably the last 45 years
something
of doing
like
this.
that. That's for sure. Yeah. So typically, I'm sure many of you have been on this call before, and we go through a slide deck which we've prepared and have sent out. But events are moving quickly. Just since this morning, the price of oil is up, I think, $8 a barrel. We're nearing $90 for WTI. When I went home last night, it was $75 a barrel. When I started doing the update to the numbers,
which was a week ago.
It was $65, right? So we have sent out our information, and we'll talk a little bit about that. But I think it's probably more fruitful exercise for us all to try and capture what we think will be the timing of some of the events that might move the industry going forward. We have a lot of unknowns right now. But let's talk about what we should be focused on, I think.
And just to be clear, Spears & Associates does have subscribers to this drilling forecast, the Drilling and Production Outlook, and those clients already have the full analysis in their possession. They've already got the data, they've got decks, they've got your written discussion about this, and this video portion is for everybody, where we sort of skim the top of the waves. Yes. And here's the shameless plug. If you would like to have access to the entire DPO, which is an annual subscription, you can go on spearsresearch.com. Super easy to sign up. It is delivered electronically to folks. Yeah. And as we make updates to it throughout the quarter, they appear on there.
That's right. Absolutely. So this is going to be sort of a free-form discussion. Richard and I have several questions we've thought of to ask ourselves and talk about. But anybody listening today is certainly welcome to send in their own questions. So we have several channels that they can reach out to us. You might want to send in the text box accompanying the broadcast here. We've even got access to our emails, and so if you want to just email us questions directly, please feel free to do that. And we'll try and get anything that comes in over the next 55 minutes answered before we sign off today. So today being March the 6th, which
of what year?
2026. So the beautiful day, sun came up just fine this morning. I always introduce a little history.
Here in Tulsa, Oklahoma, it came up.
It came up fine.
No
yeah,
bombs
right,
falling on our
right.
head.
March 6th was the fall of the Alamo back in the day. What was that, 1835, right?
Oh, really?
So, yeah,
I've never forgotten it.
Yeah, there you go, right? Of course you have. Touche, very good. Okay, Rich, so clearly the price of oil is moving fast, right?
Yeah.
It was helped in today's market moving along by, I think, two things. One was the announcement by Kuwait that they were shutting in production, and the Qatari minister spoke about the price of oil hitting $150 a barrel in a few weeks' time if things don't change. Now, I don't think the announcement that shutting in production in Qatar or any of these countries is too surprising. They don't have infinite amount of storage capacity, so when they can't ship the oil, they've got to shut in the wells pretty quickly. Right?
And for Qatar, what is it also that they are the biggest at?
Well, they are 20% of the world's LNG supply.
And how does the LNG leave Qatar?
Right, by boat.
And which direction does that boat go?
So 80% of it goes to Asia Pacific. So they do send some to
via
Europe.
Via what?
Well,
same place.
Right, yeah. Everything goes past the Strait of Hormuz. So here's another couple of numbers for you. About 150 vessels a day transit the Strait of Hormuz. Now, they're not all oil or gas. So a lot
could
of
it be
just
cars?
Regular commerce.
Could it be lettuce?
Bananas, the whole
Right,
nine
it
yards.
could be anything.
Yeah, fertilizer being exported. There's all kinds of things going in and out. So there's about 150 vessels of all kinds.
Oh, going either direction.
Right.
So one would guess that 75 are coming out and 75 are going back in.
In a normal market, yes. And at the moment, there are a little over 300 such vessels I've read that are actually in the Persian Gulf. So what does that tell you?
So about 4 days.
Right. So you go in to load up, turn around. So you're in there about 4 days typically. So that's the thing.
That's
so
pretty
there's
good.
not 10,000 vessels. Although there's also not just 20. It's a fair number, which gets to the point of so one of the choke points around this all is that there's no traffic through the Gulf, not because it's been physically blocked. There's not sea mines that they would have to dodge. At least we don't think so. There's no boarding parties of pirates out that we've heard about.
That's after you leave the Strait.
There you go, right.
Hormuz.
There's I guess you could get shot at. So, but mostly the reason that transit has stopped, as we're all aware, is that insurers have pulled the plug on and have said, as of about midnight at London on Wednesday, they ceased coverage and are now reassessing how risky and how to classify the riskiness of transiting the Gulf. And so, in the meantime, those vessels are going nowhere because the owners are waiting for clearance as to what kind of coverage they can get, and if not, nothing happens. So,
a couple of months ago,
Yeah.
I was standing on the western bank of the Gulf of Aqaba. I was over on the Sinai Peninsula, looking across the Gulf of Aqaba to Saudi Arabia.
There you go.
And if I remember right, the distance from where I was standing over to the other side was about 20 miles, which I think is the
that's the
narrow
part.
part.
At the narrowest part of the Strait of Hormuz.
But
That's
what
right.
was fascinating to me is I could stand there and I could watch the tankers, which were not giant ones.
Right.
I could watch the go between that side and this side, and it was all right there. And even me, a crappy shot with my Ruger American deer rifle, even I could have hit those guys. So it really has come home to me how narrow this crazy thing is.
Oh yeah. So that's clearly the thing. Now there have been pledges announced by the Trump administration that they would both escort vessels through the strait as well as provide insurance coverage.
Wow.
So the problem there is that takes a long time to stand up, and I think the agency within the U.S. government, which is like the International Development Bank, IDB, or something like that, doesn't not necessarily have the budget to underwrite the insurance costs, right?
Because you're insuring entire tanker loads of oil,
just anything,
of
right?
anything,
Yeah,
of
right.
cars,
Right. It's
supercars.
I think the numbers I saw were suggest that they would need the capacity to underwrite $300 billion or more, and their budget at the moment is like $200 billion. So there's some things like that are slowing down the process.
Wow.
That would see other insurers emerge in the marketplace, right? So everything, and then beyond that, then there's the whole issue of like, what are the rules? Are we just insuring those few miles while you're in the strait? Are you insuring the whole time that you're in the Gulf? Do you get insured the moment, or does the insurance stop once you've tied up to the dock? There's all those kinds of maritime rules that would need to be clarified and applied and all the rest of that stuff. So I can see it be quite a while. Now, and from a historical perspective, you may not remember, but back in
I remember the Alamo.
Yeah, well, there you go, right. So back in the 1980s, when Iran and Iraq were firing away at each other, the tanker war was in the news. And that was, again, it was like, well, we'll make you suffer by sinking tankers in the Gulf. And we, the U.S. Navy, escorted tankers for quite some months to see that didn't happen. So there has been a tanker war in the Persian Gulf before, but it was
I don't remember this.
45 years ago now, yeah. So there's some precedent for these kind of actions, but like I said, it takes a long time to straighten out. So the duration of the closure is clearly going to be one of the issues around how long or how high oil prices might go. And of course, the whole separate issue that none of us know about is what kind of damage might take place to the infrastructure, the wells, the refineries, the loading docks, all that kind of stuff, right?
My gut
so
tells
far,
me,
nothing much.
Yeah,
but,
that the wells are a non-issue. It would be take out a couple of well pads again. As long as you're not standing there when it happens, who cares?
Right.
They're easy to fix. It's the facilities that are that are the kind of the big thing. Yeah, I have no idea if anybody's targeting those or not.
Anyway, so those are many of the issues that are clearly driving prices today. And so we've heard $150 price out there. Do you have a sense as to what I should say that in our forecast of where oil prices will go, why don't we switch to a chart right now? So what we've assumed in our forecast, it can be found on our page number 4. Charlie, I want to pull that up to the screen. We've used an $80 price in our Q2 average. Yeah. Okay, and then from that point, returning to normal slowly over the balance of the year. So we end up with an average WTI spot price of $75, but that's across the entire year, and an $80 average, and which makes me feel a little gun shy given that it's already 88, right?
All right. So yesterday I was down in Mandeville, Louisiana.
Okay.
It used to be New Orleans, but now the oil and gas industry has moved across the lake, Pontchartrain, to Mandeville, Louisiana. Who knew? And glad I didn't have to help them move. Mm-hmm. But the thing I showed the team there was that the price of oil, as long as the range is between $60 and $100, that if you're an international oil company that's drilling holes in the ground, whether you're a national oil company or an IOC or whatever, that the price of oil has almost no impact on the number of thousands of wells that you drill internationally. Whether it's 60 or 90, doesn't matter.
The R squared between the price of oil and the number of wells
is about zero.
Internationally.
And whenever you go to the United States, if you look at new horizontal wells being drilled, it's almost the same thing. Certainly for the last 5 or 6 or 7 years, where you go, whether the price is $55 a barrel or $95 a barrel, 11,000 new horizontal wells, and that's your number. So, but we're now knocking on the door of the top end, and now above the top end of that, and you go, it breaks out of the boundary equation here. So that's to me the thing I'm wondering about.
I think you're right. So then the question, so the issue, so it's twofold, isn't it? Right? It's like how high might prices be, but secondarily, how long might they stay at that level?
Right.
Now, I think that's the reason why that the guys that we usually hang out with aren't prepared to take drastic action anytime soon, because just this whole issue is like, well, great, if I start drilling today and it's probably 6 months before that well comes online, what's the price of oil going to be 6 months from now? It could be, peace and harmony breaks out in the Middle East, we could be right back to $60 a barrel oil, right?
And if as you know, but maybe the people listening don't know, our clients, we have 500 corporate clients. We have Saudi Aramco and ADNOC and Chevron and Conoco, and we got the great big oil companies as our clients. We have pretty big independent oil and gas producers kind of all over the place as clients. We got the service companies, and we got the investors in that sector who are also our big and primary and beloved clients for this. And I think that each of them, each of those groups can behave differently in this environment. And not that I'm saying, I don't speak for Chevron or Conoco, but let's just use them for an example. Do you think they care at all in 2026 for their drilling budgets anywhere on the planet what the price of oil is?
No, I don't think. No, I don't think so. For one thing, those size companies justify their programs anywhere based on what they think is the price deck over the next 5 or 10 years, right? So what happens today is not too meaningful. Now what more often drives the needle for those kind of companies is when they do an acquisition, right? And now they've got to rationalize operations, and that might cause some changes, but
you bet.
It's not
the
a price
of the commodity is baked into the system already.
Not so much, yeah. No, so that's the big guys, and I think the big independents. So we'll move slightly down a notch and talk about the Conocos and Devons and EOGs, those kind of companies.
A Diamondback, somebody that's fully committed.
Much the same, I think. Much the same decision process. And again, those are all publicly traded. I think we could just extend it to say anybody who's publicly traded, right, has a management team that has been both conditioned and incentivized to not chase their capex dollars. Their capex dollars don't chase the price of oil or gas.
And that's because their investors have said, I want my money back, and I want it in the form of a dividend. And if you guys are doing great, your stock price will appreciate and will benefit from that too.
I think
but I want to be paid a dividend. I want you guys to be profitable. I want profits over growth.
Right. Yeah. Absolutely. Yeah. Absolutely. So strangely, if the price of oil goes up, which then their plowback rate, their reinvestment rates, I think will fall. Right, because they'll have more in the denominator, then in the numerator will stay largely the same, right?
But that's the time when you want to be a shareholder of a company, of a publicly traded oil company, because they're going to have profits that are to the moon and back,
something like that,
and they will dump that into the pocket, which I think then begins to change the mindset of the investor, going, okay, go get me some more of that.
There's clearly within the investor community been sort of two camps that have emerged. There was just one camp, which was the price of oil is only going to be soft because we're transitioning away from fossil fuels.
A 1999 approach
or a 2021 approach, something like that. But now there's clearly another camp, which is that demand growth will continue. And as a result, there's a future for the oil and gas industry. And so now let's think about where just demand and supply, where the fundamentals might take prices. And if that's the case, then these companies have more value than we have been accrediting them over the past couple of years. So I'll go back to my slide number 2, Charlie, and talk about, here's just our outlook, just sort of briefly talk about what the numbers look like from a supply and demand standpoint before the shooting started, right? So expectations were that global demand would grow on the oil side would grow about 1.2 million barrels a day, just slightly above where it was last year. So we've been perking along at somewhere between 1 and 1.25 million barrels a day incremental growth in oil consumption on a global basis, and that's kind of been the forecast. Or that's, I should say, that's the forecast. Yeah. The near-term forecast seems to sustain that. And as the point I've often belabored in the past is most of that growth is coming from emerging markets, very little from industrial economies or even China. So that's the base case that, again, many had incorporated into their plans. The supply side was a little bit different last year. As you can see from the chart for 2025, we produced incremental growth in oil production was somewhere in the neighborhood of 3 million barrels a day. So we the market got soft. It was way oversupplied, right? And so that's why we saw prices go from 75 to 60 last year. And this year was planning to be more normalized, somewhere around still a little bit of an overproduction, but something maybe more along the line of 1.5 million barrels a day versus a demand number of, again, somewhere around 1.25 million barrels a day. So a bit of a mismatch, but again, that was all before you began to shut down the Strait of Hormuz, right? And so the supply side numbers are going to be materially different.
Hey, so do you have a slide in here about the global gas market?
I don't have about gas. I do have about global gas. I do have about LNG.
So it's appropriate because our dear friend Amy sends the following question already. So by the way, you can send us questions right now.
Right now.
Clearly, if you're watching this a year from now, don't send a question. Or even if it's tomorrow, or even if it's this afternoon,
10:15.
Don't send a question. You can do it live. So you mentioned, and I think she's talking to me.
Yeah.
No, to you. You mentioned Qatar, and good luck figuring out how to pronounce that country's name because it's a million different ways.
Yeah.
That Qatar, as 20% of the natural gas
LNG
exports. Natural gas prices have risen significantly. What's your thought on gas prices, and particularly Henry Hub, the gold standard in the U.S. versus LNG?
Right.
And do you have any thought about Europe and Asia? So
that's
the short question.
That's a short question. Let's hear it. So this is our slide number 3.
Amy has asked us tough questions
all the time,
for 25 years.
There you go, and we're getting around to it. So these are the numbers for LNG exports. On the left-hand side of the chart on slide 3 is total LNG exports, which added to about 50 BCF a day last year. They've been growing over time, and the elements of the bar, I think Qatar is in red. So it's about 20%. The U.S. is also about 20%. Australia is the third biggest outfit, and then there's a whole host of other countries. So and then the chart on the right-hand side looks at LNG prices on a global basis. And so the blue, the low line there, represents the U.S. export price for LNG over time. Last year, it was around $8 per million cubic feet. And that was at a time when Henry Hub was $3.50. Okay?
Hey, I can do that math.
Yeah. See, so
a little more than 2x.
Foreign customer, the export markets were bidding away gas from the U.S. because they're willing to pay 8 and change, or around 8, I should say. And domestically, we were selling the stuff for a little bit less than that. So
is that spike Putin's invasion?
Yeah, 2022 was the invasion, and when Europe pivoted and said we're not going to buy Russian pipeline gas, we're going to import it, and that caused shortages everywhere. That's a huge demand spike. You don't see it on the supply side, do you?
Because no, because we couldn't do any more.
Right. Yeah. So they were short, and so prices rose accordingly, but then settled right back down. Right.
So if you have a thing like that, that was one country invading another country.
Yeah.
We have an entire region now. Or can you use that spike as an analogy for?
So what happened? What happened this past week is that prices in Europe went up about 50%. So they had been trading at somewhere 50%, right? So they been trading their LNG import price was somewhere around $11 or $12 per million, and so those overnight went up, around 50%. So you've begun to see that now. The concern in Europe was that they're coming out of winter, like everybody else who stores gas. The March, April, May period is when inventories bottom, and then you spend the rest of the summer refilling them, right?
Yeah.
And the worry there is that where are we going to refill the gas? Where are we going to find the gas to refill our inventories? And so yes, there's a similar worry that they may have to bid away LNG cargoes from China or the Asia Pacific market in order to refill the inventories that they're looking to.
The fact that this war is happening at the end of a winter as opposed to the middle of a winter,
or something like that.
maybe the imperativeness to reload an inventory.
Well,
there's not as great as it
clearly
was.
in the U.S. there's a lot more capacity, right, than there was in 2022. So we have more supply. Options than and capacity for the folks over in Europe than there was, and so that might help things a little bit. But it was interesting because before the shooting started last week, the thought had been that with all the new LNG export terminals coming on stream here in the U.S., that globally the price of LNG was going to fall a couple of bucks this year. So last year we averaged $8.
Oh, because demand is the same.
Roughly the same.
And supply rises, so therefore the price falls.
Yeah. So the thought had been that instead of an $8 LNG export price in the U.S., we'd see like a $6 LNG export price this year. Now, and everybody else would sort of see the same kind of rollover, as it were, because markets being markets, right?
That's fungible. Gas is gas.
But now the thought is that, well, maybe this isn't the case, that we'll see prices go up 10%, 20%, something like that year over year. So,
well, if you've taken 20% of the market off, and that's the supply off. You haven't taken any of the demand off the market.
Not yet.
So if you've taken 20% off, and you're in day 7 of that. Same thing with the oil.
So you haven't. So the supply hasn't really crossed over yet, right? Because there were a bunch of boats that left last Saturday, right? And they're still on their way, right? So we probably won't begin to see, the whole bit about where's that next cargo, right? Until another 2 weeks go by or something like that. And kind of same thing on the oil tanker side.
It's end of March before you look out in the bay and there ain't no tankers out there.
Began to feel a little lonely. Yeah, that's right.
Or the tankers that are out there are just they're idle because I'm not going back there until the shooting ends.
Pulling away from the dock, and that's absolutely right. So it's a tough market. I mean, 20% is a big number, right? And that's a bigger. So LNG exports from the Mideast, 20% of that of the global supply is a bigger percentage than what the oil markets rely on through the Strait of Hormuz.
Oh, because it's 15% of the oil markets,
right? So
and 20% of the LNG market.
Yeah, something like that.
All right, so it's a bigger.
So it's a bigger hit, right? And you don't have strategic petroleum reserves of gas like you do for oil. So, I think a bunch of different things are beginning to move in the next 48 hours.
It's hard to store, right? You don't store it
there's limited capacities, right? And and nobody builds up those kind of reserves. So I suspect, though, in the next 48 hours, we'll begin to see several countries announce beginning the release or plans to release, their strategic petroleum reserves in order to offset the loss of.
Of LNG?
No,
or
I'm sorry,
oil?
Oil.
Of oil.
Yeah,
okay, got it. Just want to be clear.
Pivot there to oil.
Got it.
So I think we'll see those announcements quite soon. That'll probably help. Restrain some of the wilder aspects of the market. Now, how much on the strategic petroleum reserve side does everybody have? So China's got 1.1 billion barrels of crude socked away, and I read that that's enough for about 90 days of supply for them. So they import, probably about 2/3 of their oil from the Middle East,
So-
or maybe not all from the Middle East. They import about 2/3 of their oil. A biggest part of that comes from the Middle East. Yes. Yeah.
So in terms of areas of the country that consume oil,
Yeah.
this war in the Middle East has the biggest impact in which areas? I mean, China, but they got the big buffer.
Right. Yeah. Yes. Right. But well, so 80% again of the crude that leaves the Persian Gulf goes to the Asia Pacific markets. So that's where you're going to see the impact. Now, Japan has a significant amount of its own SPR. Can't tell you about South Korea, but all those countries I think are going to be. We'll find out who's got SPRs and how much they're going to start releasing as a way of again buffering their domestic consumers and buying some time to solve this problem of both insurance and safety.
It's the whole reason why the country has that inventory.
Oh,
It's for an
absolutely.
event like this.
Something like this,
So,
yeah.
good for
Yeah.
them for thinking about it.
We have, I think, about a little over 400 million barrels in now. We don't. I mean, we're oversupplied, right?
We're
we're
kind of
an exporter
self-sufficient
right
at
now,
this point.
At this point, so it's not like we need to release those reserves in order to meet our own demand, but it would also help, with tamp down global prices. So I would expect us to fully kind of join in the parade when it comes to those kind of announcements as a way to dampen price movements.
I saw a guy crowing on LinkedIn yesterday about how he, in his electric vehicle there in the UK, was driving past the 90-car lineups to fuel their cars that required petrol.
Yeah.
And he says, "I'm just going to drive home and plug in, you suckers." And I thought, well, maybe this event is a good shot in the arm for EV sales.
So there you go, right? There's a whole series of anticipated consequences that might
anticipated
come
and
about.
unintended consequences.
Well, the unintended side is good to ask about, and we'll be talking about those shortly. So, one other question. So, the question of how high oil prices go, I think, is intimately linked to how long the Strait of Hormuz will be closed. Right?
Are you making a military bet on this one? Because it's not today.
I'm guessing it would. I'm thinking it would be about the end of the month before we begin to see it
And
come back up.
of what year?
Yeah, this year, hopefully. Yeah,
It's this month and this year.
But even beyond that, there's the issue of then you have to sort of stand back up export capacity. If you've shut in wells, if you've, some of that might take some time. So that's why, like I said, in our estimate of where prices might go, we'd said, okay, the second quarter is the pain point in terms of high oil prices, but beyond that, then it begins to normalize. And I think, we could expect that the underlying fundamentals of the market would say that when things do normalize, we're back to around a $65 price of oil on the back end of all this. So,
65.
Yeah. At least near term, right?
Yeah.
It goes back down at some point. Where does it stop going back down to? I think it would be something like that. So, but again, not much of an impact and nothing that materially changes where we think drilling activity goes. So I'll go to our slide, which is I think number 6 over here, which looks at the estimate that put together in this forecast as to rig count and the like. And you can kind of see from that, if you got it up there, Charlie, we were calling for exactly 561 rigs to be active this year, which
that would be an exactly average.
That's exactly average, right? And strangely enough, that was the very same number we averaged last year. So, so rig count standpoint,
then pretty much nothing happened.
Pretty much nothing goes on there. As a result, well count comes in by our lights. At the moment anyway, just shy of 15,000 new wells drilled, which works out to be about a little over 11,000 frac jobs over the course of 2026.
Which is essentially one frac job per well. You'd drill a well,
right.
you frac a well.
All those 15,000 wells drilled, about 12,000 of them are oil and gas wells. You got to, you salt in some dry holes.
Well, but But again, like the conversation in Mandeville, Louisiana yesterday,
Right.
in the places of the country where you drill a well and you got to frack it to make oil and gas come out of the ground, these days and for the last year or so, operators have been employed the strategy of, if I drill it, I will frack it.
Absolutely.
And I'm not going to drill it just for some dry, inventory of holes in the ground.
Now, if you look at it nationally, our drilled but uncompleted numbers have continued to fall. Not drastically, but they're down, and that would match up with if it gets drilled, it gets fracked. So that's the path we've been on for a couple of years now, and I think that's the case as well. The other thing I would point out is on my next slide, which is number 7. Yeah, slide 7, which is kind of neat because while we've said the year as a whole ends up pretty much the same, 560 rigs year, no change year over year.
Oh, right.
We're seeing a couple different things going on. Broadly speaking, fewer oil-related rigs and more gas-related rigs, and the decline in one is offset by the rise in the other. And then when we look at it by region, rig count is down in 2026 in our oil basins, but rising in our gas-focused plays.
And just for those of us that are new to the industry, what are those basins that are oil, and what are those basins that are gas?
If I should lead with Permian, because Permian's so what you find when you look over time and do correlations, the Permian rig activity correlates very nicely with oil prices. And most of the wells that are drilled and completed there are classified as oil wells. They produce an awful lot of associated gas.
They all produce gas, but so much of that gas comes out at $0.
It's a $2 billion market for oil and gas processing equipment. So what does that tell you, right? And just in the Permian,
just for the processing equipment.
Just for the processing equipment.
There's a lot of gas that
$2.5 billion. Something like that. It's a huge number, right? Because they got a big gas problem. It's a nasty gas. It's liquid. There's a lot of treatment that needs going on. But Permian, Bakken would be the other one that's very oil-centric, obviously, and matches up nicely with movement in oil prices. Haynesville and Marcellus are both dry gas for the most part, are much more in tune with the movement in natural gas prices. And natural gas, again, this year, the futures market, when the year started, had called for natural gas, or estimated that natural gas prices would average over $4 an MCF, up from 3.5 last year. Well, we've had some spells of very cold weather, right, here in the U.S., but inventories of gas are above where they were last year, and that's going to weigh down on prices. And by our lights, we'll probably see gas prices average around $3.5 once again, which, generally speaking, is, the big gas plays like Haynesville, Marcellus, that's a profitable number for them, for operators up there.
From a service company point of view, from the service company's point of view, if you look at a Midland Basin, Permian Basin well, and say that's worth $1 to me as a service company, if I go over to the Haynesville or go over to the Marcellus, Utica, that $1 per well now becomes $1.3, $1.5.
30% or 50% more valuable, as it were, those rigs are, because of what you can sell and the price you can sell them at, that kind of thing.
The interesting thing is you look at a flat rig count, but where the mix is changing the gas, the amount of dollars spent on oilfield services rises at that point, right?
Oh, sure, right.
Because the wells are more expensive. Yeah. Now there's not as many of them, but these are more expensive wells. So if I'm selling frac jobs,
right,
this is actually a pretty sweet trend. Where would I rather have a frac crew go to work? I go Haynesville, not Midland Basin.
So while we're talking about oilfield service pricing, one of the things we have seen in the data for the past couple of years is that, broadly speaking, drilling and completion pricing has softened. Not drastically, 2% per year, something like that. We thought, well, maybe that'll be the case now. But I'm thinking that as of any pricing discussions that began next Monday, that it will be very difficult for operators to get compliance with a request that says we need you to lower your prices, because the service companies will say, but I see the price of oil is currently $90 a barrel, so you're making money hand over fist. I don't feel as though I need to underwrite your E&P operations. And so I'm thinking that decline in unit costs that we have seen and anticipate would continue is probably coming to a stop. So we may not see more rigs go back to work, but I think we'll see perhaps more resolve on the part of oil service firms to not lower prices, to resist the siren call of discounting.
Well, and to be just super clear, because you look at the change in prices for a bunch of oilfield services every quarter in a bunch of basins. Yeah. And that erosion of price was, the big erosion of price was largely a year or two ago. Yeah. And over the last year, it's been remarkably stable because drilling activity has been remarkably stable, wouldn't you say?
Oh, yeah, absolutely. Yeah.
And so you go, well, where is it? Where is the capacity in the industry to actually grow? And if you look
grow
at
activity,
and again, we're still talking U.S. If you've got H&P and Patterson, those two drilling contractors have seen as a combined, those two guys, about 20 drilling rigs that were working last summer that aren't working today.
Okay. Yeah.
Now, as everybody knows, I'm on the board of Latshaw Drilling, and Latshaw's got every rig that can work right now is working. So it's like its demand has gone up for a variety of reasons. Small potatoes, though. It's a small company versus these other two guys. So if you're an oil company, a small oil company that's very responsive to oil price and gas price, and you go, I'm getting me a drilling rig, you can call H&P or Patterson.
Yeah, and they'll talk.
And they'll get you a rig at $35,000 a day or whatever their day rate is. But then they call the frac company.
Oh, okay.
And because of simul-frac and trimul-frac, I think that for the big frac service companies, the guys that can handle big multiple day, month-long projects, that virtually every pump truck is busy right now. Now, on the smaller end, if you got a 1-day job, 2-day job, there's always capacity around those edges, but that represents this much of the industry.
Sure.
I think the choke point is try to get another frac crew for then 6 months from now.
For a substantial type
job.
Yeah, but
if you want one pad done, and you can wait, you can get that done. But if you've got a 50-well project,
but who wants to wait when prices are $90?
I would like to have already done it. Wish I'd completed it yesterday.
Hurry up, guys. So an excellent point there. So limited amount of, and we'd seen that, utilization levels had been broadly flat, maybe gradually tightening, like you said, in different sectors. And at some point that was going to be, that we would expect that would begin to kick off another round of rising prices to get wells drilled and completed. That day may have come more sooner than we had anticipated, just because of the dynamics on commodity price side and things like that. So, again, another reason to say, okay, John, coming out of December of the fourth quarter of this year, if oil prices have come back down, but they're still at $80 a barrel because, God forbid, stuff got blown up in the Middle East that we're all counting on. How many rigs would go to work at that point, right? And just as you mentioned, the supply response in terms of rigs and things like that would be constrained by what is what's out there that's idle right now, and there's just not a lot of that. And that would be the case in not just the U.S. but Canada as well. And then, of course, constraints internationally are being what they are. It'd be tough to get a big kick in terms of activity just by moving, that would come about just by seeing oil prices at, say, an $80 price, something like that.
So my friend Dave asked a question, which is, there's already discussions of maybe, of the government maybe, pulling away the permission to export oil. That would be the U.S. exporting oil anywhere. And were the U.S. government to do that, then on that next day, the amount of oil piling up would be enormous, right? Because Because you export how many million?
Well, so it's the net number is about zero. I think we export about 3 million barrels a day on the crude side and import about 3 million barrels a day on the refined product side. So
because it's got to go to out to the Caribbean, get refined, come back.
Something like that, yeah. And that's a net export number because we're still importing some crude from Canada, right?
You bet.
And so anyway, but I think our net numbers are about 3 million of crude out, 3 million of refined in. At this point. And we also have natural gas liquids, which, 4 million barrels a day of that goes out or something like that.
Look, the U.S. government, I don't care which party is in office, doesn't do things that make economic sense to me, but governments can do whatever they want to do. and were they to halt exports of these commodities, then the price inside the United States would drop, right?
Yes, for a while.
I mean, I think if you've got, I can't put the oil anywhere else. I can't put the gas anywhere else.
No, right? Yeah, it would be April of 2020 all over again, right? I remember the pandemic, right? And we shut in the economic project called the U.S. in early March, and by the middle of April, we had no place to put the oil. And it went negative.
And it went negative. Right? Yeah. So I mean, whether
you would get a lower crude price,
which would then rocket right through the whole drilling industry and the frac industry and go stop.
Yeah,
stop.
right. No, so you can see that kind of thing. So second order effects, I think, would control the decision. So you can get lower oil prices, but then you begin to close in big chunks of the economy.
Of your economy.
Yeah, right. And that just upsets everything. So,
oh, golly.
Yeah.
So it'd be like a war, but without any bombs being dropped on your head.
Something
I'm
like
stopping.
That, right? I suppose that's right. Yeah. So
all right, we got 15 minutes left. What do we need to hit?
Right. Did you have any questions that had come in or you had thought of ahead of time that we...
I got any number of questions. Let's go.
Here's I've got one for you.
Ooh.
So the Middle East, Charlie, let me advance this to my slide number, what is that, 12? Okay. I think that's what it is.
This is international rig count.
Rig activity. Right. There you go.
All right.
So on the left-hand side is the total international rig numbers as we're trying to estimate. So they came in last year somewhere around 1,040 active rigs. We think this year they have been on track to go up to about 1,065. So a 2 or 3% increase this year, and then carrying on that same kind of recovery, as it were, for after 2026. The biggest single element in the international rig count market is, of course, the Middle East, right? So the rig count there is 400 or so rigs.
And that's a Baker Hughes rig count.
That's a Baker Hughes rig count.
It's not necessarily the active rigs in the area.
That's right. I correct myself. It's around 520 rigs, of which a big chunk of those, almost half of them, are what they call operated rigs in Saudi Arabia. But the point is that that's a major element of the international drilling and completion market, and has been one that all the major service companies have pointed, and many of the second and third tier companies have pointed to as an engine of growth opportunity for them oilfield service firms, is look what's going on in the Middle East. We're going to be a part of that story and enjoy good growth as a result. Other areas around the world are growing here and there, but the Middle East, you look around most of the countries and say, oh, they're all beginning to expand capacity to produce oil or gas, and so there's just demand for our stuff. If you're a drilling and completion contractor, it looks pretty good. Well, if the Strait of Hormuz is closed, not only are you not getting oil out, you're also not getting supplies in. And what's your take in terms of how long from an operational standpoint, the service industry in the Middle East can continue at pace until, hey, we're looking for a left-handed widget in our inventory and they're all gone now. So what do you say there?
And from, as John knows very well, I have the pleasure of being an owner of and sitting on the boards of a few oilfield service companies that do manufacture and have the Middle East as our largest customer base. And, we were all pretty giddy in our board meetings in January and February about specifically Saudi Arabia, but the whole rest of the area, because as disappointing as last year was with regard to drilling activity, yes, Saudis, took a bunch of rigs and made it a few rigs throughout the course of the year. Those drilling rigs were already coming back, and Q1 was better than Q4, and Q2 is better than Q1.
What were the Saudi plans were 150 unconventional wells this year?
A bunch.
300 next year?
A bunch.
450 after that, right? So
a bunch. And those are huge consumers of things that a service company would provide.
But none of which are actually made in the region using materials. Raw materials sourced in the region, right?
Good point. Because, for example, our manufacturing, and I won't do an advertisement here, but our manufacturing is in Saudi Arabia. But everything that gets manufactured relies on a truck showing up or a boat showing up.
Right.
And you are continuing that operation today while dodging missiles being dropped on your head.
Yeah.
But you run out in about 3 to 6 months. It's not right away because by contract, you have to have a bunch of inventory there to make the Saudi Arabians want to do business with you.
Sure.
So it doesn't run out right away.
But there's a fuse that's been lit.
You bet. And the clock is ticking.
Right.
And so how are you going to satisfy that? And there's always cargo planes. You can hurry and get stuff there from wherever else. But that's so expensive that how do you do it? So if the war ends today, no problem. If the war ends in another week, no problem. If at the end of May,
we're still talking about this when we get back together.
That's right, in June. Then you can assume that the Saudis aren't, and the Kuwaitis and the Qataris and the folks in the UAE can have a super hard time.
Right.
Because, for example, somebody described, if you're building a car, if you're a car manufacturer and it's got 100,000 parts, if you've got 99,999 parts, but you're missing one.
That's the car I bought.
That's right. You haven't built a car.
No, you haven't.
It's just a paperweight until you get that last part. And that kind of runs into the issue here.
So now, not very few other parts of the world are reliant upon Mideast supply to keep activity going in Africa or South America or some places like that. So the region is not a big export source for oilfield equipment.
Stuff. No.
So it's really all about what the localized impact would be there of a shutdown in commerce. Going on. So that's a possibility. We'll be watching that one pretty closely because, again, it's like all of a sudden I don't have the right kind of washer and wait a minute, the whole rig isn't working like it should, or I don't have the bit that needs to go. So,
if you want as close to a real-time metric on what's going on in the Middle East with regard to demand for oilfield equipment and services, 3 companies, ADNOC, NESR, and TACA. Keeping a close eye on those guys because that's going to be your bellwether about how things are going.
Publicly traded, so I think they would be making announcements, I presume.
You should be able to get something, a clue, some more clues.
Good. Okay. Well, right. So that's good to know that that there's still some inertia in the drilling process, but it'll have to be something that we need to keep an eye on. Another question's come in, and I was going to highlight this in the conversation.
I was going to avoid Venezuela, and you're going to address Venezuela.
Right. Actions in Venezuela, what was that, January now, right? That have reconstituted the outlook for that country's E&P industry, right? I've been surprised at how quickly, at least on paper, things have changed. There's been a much more supportive foreign investment petroleum law that was passed. Now the U.S. is controlling the sale of Venezuelan crude and then dispersing money back into the country. So exports are, and because they need naphtha in order to produce their heavy oil, so we're letting naphtha into the country, so their production will rise a little bit. But at least initially, the thought was that the above ground stuff, laws and so forth, were so opaque how that might go. That was oil companies weren't revisiting plans. And now that I think some have gone in, what I think I'm hearing is that they're looking around saying, the Venezuelans and other operators down there just did not put any money into maintenance and upkeep for their surface production facilities.
Just like the way I would treat a rent house.
There you go. Right.
Like,
and
it's got a roof.
Yeah, right. You'd have the party lose your rent money, last day, right? So there's a huge cost that it has. I mean, you see numbers that are in the tens of billions of dollars, hundreds of billion dollars that would be required to sort of upgrade the surface processing stuff before to get it up to, say, Western standards. And so that's a real hang-up then, right? Because anybody going in to operate any Western company wanting to go in and operate would insist that what it does there matches how it operates in other countries. It wouldn't cut corners just because it's Venezuela. So that's a heavy carry. It doesn't when it comes to the investment required to operate in a country. It's not just drilling the wells and putting in a few tank batteries and things like that. There's upgrade that needs done as well. So I suspect that we'll see some of the companies that have been involved in the past, like Chevron, like Repsol over in Spain, take steps over the coming year to resume operations in country. But I don't see it happening very quickly.
You're not helping me because, the management team and I own APS, which makes MWD, LWD tools that independents and majors buy. And for a period of time, about a decade ago, Venezuela each year represented $20 million worth of purchases. And
good for
then it's went to zero.
So sanctions, sanctions have been a big part of that, right? And I suspect that those will be relaxed, if not removed, and so that may help a little bit, because not only has there been underinvestment in surface facilities, there just hasn't been much drilling going on there. The folks at Baker Hughes thought that when they've counted rigs, they've only come in with one or two working in Venezuela.
I think both of them by
something like that. So there just hasn't been much activity that we're aware of, and I hope that we can find out more so we can get a better job of counting what's and reporting on what's going on out there. But I really think that's, if earliest, a 2027 story for a handful of companies, and maybe then more of a 2028 and beyond kind of a story.
I'll call the guys in Connecticut to say, don't buy it.
Yeah.
So here's another question by a different day.
A different day. Well, I like that. Yeah, right.
You read it.
Yeah, from a different day. Do you think offshore and offshore services will be growing much over the next 3 years? An excellent point.
Hey, and I was in Mandeville, Louisiana yesterday, and it was all offshore, pretty much all offshore.
Yeah, right.
And I met the guy who's just brought on stream the 4 largest producing wells ever in the Gulf of Mexico, or Gulf of America, sorry.
Right.
28,000 barrels a day each.
Yeah, there you
and there's still these fantastic gems that are all throughout the Gulf. And I'm meeting with the Schlumberger guys about, they're building a couple of new frack vessels there because the rock that they're producing from requires an actual, honest to goodness frack job, as opposed to the other stuff that they've been doing. So pretty interesting opportunities.
A lot of dollars being spent, right?
But it's still an abandoned area, a late life field that hasn't gotten any love because all the love's going out to West Texas. Does this thing, which is I think the question here, does this war cause investors and boards to go, oh well, how about very little chance of missiles falling, along the Louisiana-Texas coast?
You say.
Does money go here?
Well, just from a rig count standpoint, I think it's hard to see much of a change. Again, deep water rigs are highly utilized.
3 wells per year is the number they told me yesterday.
Yeah. So, and if you need a rig, you need to build a deep water rig, and that takes
how many years?
3 years probably.
So
there,
1,000 days.
Yeah. Oh, yeah.
To get the thing floated over to you.
Right. So rig count numbers, new well drilling numbers, I don't think can change very quickly under any kind of a higher price scenario. Now, service work, maintenance work on older wells, where you're trying to establish production, go deeper, or some things like that.
I'm getting the supply vessels ready right now.
Maybe so. Yeah, you've got a lot of platform rigs out there that could do some work, perhaps.
Yep.
And I should mention that even before the news out of the Middle East, that we saw, one of the big disappointments for anybody in the oil patch has been the collapse of the UK continental drilling activity in the UK, and the big hang-up has been this EPL, this Energy Profits Levy, that the government on its own has begun to say maybe we should phase that out faster than 2030. Right, and as a way of sort of sustaining production, and maybe more importantly, job count in the offshore sector up in Aberdeen and places. So we might see some things like that go on that would help a bit, because there's marginal fields in that area. So there's maybe some marginal field work that could get done with jackups of sorts that you might see a little pickup here and there, but it's. But I don't see it as being a big explosive area. And of course, we just had two of the big offshore drilling contractors merge, right? We just had Transocean
that's right.
and Valaris.
Valaris.
Yeah.
Yeah, and not to, we have had such a lack of focus offshore in the United States for such a long time that the expertise has migrated elsewhere. So there's also
That's an excellent point. Yeah.
So don't forget that.
What's the biggest offshore market these days? Brazil.
Yeah, probably.
Yeah,
so we're all down there speaking Portuguese.
Yeah.
All right. So we're right at an hour, John, and I want to be respectful of you or whomever. But was there any other slide that you wanted to show before we?
I think we've hit the high points. I'll tell folks that we'll monitor things, and as stuff comes through that. Materially changes what our expectations are, then we'll certainly be updating numbers, and the subscribers will find it by accessing our website and go into those documents.
And that website is what?
www.spearsresearch.com. So.
And a year ago, we migrated everything that we do to a digital format.
Right,
so everything is now delivered through the website.
Right.
You can look at everything we do on your iPhone if you're subscribed to it.
And it's posted there when we update it. Right?
That's right. And we make updates to it quite literally every day. Yeah. Maybe not to all 17 of the services we've got, but every day something new.
Yeah. Anyway, good stuff. Appreciate it. As if anybody has more questions next week or beyond,
you got to wait 3 months.
No. Send them over. We'll get back to you ASAP. And in the meantime, take shelter and hope for the best. Thanks.